What drives prices? What is the single factor that drives prices in the markets up or down? Think back to a time when you were buying an instrument. How many times have you made a decision to buy or sell based entirely on your emotions rather than the logical process? You are not alone. Every trader, every investor, and every fund, while having their own parameters and rules to be considered for trading, when it comes to executing the order, we look at the prices and in the last second, we take a trade. Many a time we have made up our mind to buy a stock, but when we find the prices are in a marginal decline, irrespective of our study, we listen to our only emotion, the emotion of survival, and we sell a stock we wanted to buy. Or at best, we decide to stay away, only to see the stock rallying away and regret our decision. The only true emotion that drives this market is the fear of losing and the stronger emotion of greed. The truth is, markets will go up as long as there are traders willing to pay a higher price in the hope of selling at a higher level at a future point in time. And markets will keep declining as long as there are people who fear the present price may not be seen in future. Professional trading skills. Having observed successful traders over the last 3 decades, it can be said that there are broadly just 3 skills or areas which are the most important for putting profits in your account. Trend change and trend continuation. The average retail trader and also some large traders have a fetish to chase after a trend change, and in their quest for that one trade that gives them that perfect trade, miss out on several trades that can put profits in their account several times. The sensible professional trader, however, is always on the lookout to find trades that indicate a continuation of trend. While trading the continuations, they are aware that they will lose money on some perfect trades, but they will gather more profits on the trend continuation trades. And once the larger trend changes, they are still able to reverse and trade in the other direction once they see a larger change in trend. Risk-reward ratios. Many retail traders do not understand risk-reward ratios and conveniently disregard this most important factor of trading. With all the skills and with all the knowledge, trading financial markets will never show 100% successful trades. There will be misses and hits. Forecasting and trading markets is a science of probability, and it can never be 100% perfect. That said, we can still make speculation and trading probabilities a winning proposition by putting the risk-reward ratio in our favor. Assume that we are the most average traders and we lack any special skill or knowledge. The law of averages guarantees that we will still be correct half the time. Now assuming we are beset with the worst abilities, we will still be correct about 30% of the time. No one can escape those odds. Correct only 30% of the time. With a little understanding, we can put this worst odd also to our favor. How? We execute no trades where the risk-to-reward ratio is less than 1:4, meaning for every dollar we risk, we will look for a $4 profit. Assuming we execute 100 trades and 70 of them hit out stops, we are saddled with a $70 loss, and the other 30 trades yield us a profit of 30 into $4, $120. In effect, we will still net a profit of $50 after being incorrect 70% of the time. Money management. Most professional traders risk only 1% to 2% of their portfolio on any trade, however promising the trade may appear. The retail trader and the unskilled trader, on the other hand, has only 1 to 2 trades, and the risk thereon is more than 10% to 20% of their portfolio value. Risking just 2% on any trades allows the professional trader the luxury of executing 50 consecutive trades before he is totally wiped out. The odds of 50 losing trades in a row is 1 in a million, and no man can execute a million trades. Hence, we assume risking 2% of portfolio on any trade will keep us in the game of trading forever. Another point to note is with a risk-reward ratio and a 2% risk on any trade, every winning trade adds 8% to the portfolio. And sooner than later, when the string of successful trades are seen, we will have multiplied our portfolio many times over. We see that the most commonly understood rules of the market are misrepresented and lead us to take a wrong choice and trade in the wrong direction of the market. We only need to understand the larger trend and the true language of the market to be on the right side of the market. Open positions, central bank interventions, interest rates, overbought or oversold conditions, earning analysis, price of crude oil, inflation, activity of HNIs, and many more are just several factors that do not lead us in any way to be able to forecast the trend of the market with any amount of certainty.